Are you looking for a passive way to invest in the stock market on autopilot without having to go through the hassle of picking and choosing stocks? I know I am, and that's the focus of this video. I'll be sharing with you how my wife and I have built a passive investment portfolio in the stock market close to $500,000 in size, and that has very low cost and aims to return about that average market returns of 8 to 10% per year. And on top of that, it does earns us a nice, decent dividend distributions per month, averaging around that $900 to $1,000 each and every single month. If you are intrigued by that and are wondering how you can start a similar passive investment portfolio, this video is for you. Our investment portfolio consists of mainly 9 different ETFs. All of them are considered to be low cost and high quality, and they give us exposure to a wide variety of markets on a diversified perspective. We get exposure to Canadian stocks, we get exposure to US stocks, we also get exposure to international markets as well as emerging markets. Let us start with the US ETFs that we have in our portfolio. One of them is iShares Core S&P US Total Market Index ETF, the ticker symbol XUU. This ETF is offered by BlackRock, and the last trading price of it was at $40.98. Year to date, this ETF shows to be up by close to 6.6%. What's so unique about this ETF is that it gives us exposure to the entire US stock market. It's low cost and is designed to be a long-term core holding. Looking at the past performance for XUU, you do notice that its 1-year return at the end of March was down by 1.1%, 3-year annual return of 16.3%, and 5 years annual return of 11%. As for its return since its inception, it's at 11% annually. The inception date for this fund goes back to February 10th of 2015. XUU does pay dividend distributions on a quarterly basis, and currently its distribution yield is showing to be at 1.48%, close to that 1.5%. Looking at the fees for this fund, the management expense ratio is only at 0.08%, which is just a fraction of a point. Very, very decent low fee for a fund that gives us exposure to the entire US stock market with a medium risk indication. In terms of the holdings, the majority of this holding is actually other funds that belongs to iShares BlackRock, and gives us exposure to financial sector, as well as healthcare, industrials, information technology, and you name it. Looking at the specific sector breakdown, majority of the exposure here is to information technology at about 24%. Following that, we have exposure to healthcare, financials, consumer discretionary, and industrials. You do notice that how we get exposure to the rest of the stock market sectors as well, based on the percentage points showcased here. The next fund that gives us exposure to the US stock market is Vanguard Total Stock Market ETF, a product by Vanguard. This one is offered in US dollars, VTI, and it's very suitable for us because it's offered in USD. We are holding this VTI in our RRSP account, and that way there is going to be no withholding tax as a result of that. VTI has a very small ratio, management expense ratio of only 0.03%. Looking at the 30-day SEC yield for the fund is at close to 1.6%. The last trading price for VTI was at $205.06. Looking at the year-to-date return at the last trading day for this fund, it's showing to be up by 7.7%. With VTI, you are noticing as well very decent returns. If you look at it based on the 1-year return at the end of March, it was down by 8.8%. How about 3-year return is showing annualized 18% plus, 5 years annual return of 10% plus, and 10 years annual return of 11% plus. Just incredible returns. Very, very decent for long-term investors. And if you go back to in return since its inception of going back to all the way to May of 24th, 2001, which is long ago, over 20 years ago, is showing an annual return based on market price of 7.8%. For VTI, you're getting exposure to close to 4,000 different companies in the US stock market. Mainly, they are the ones that are focused on large cap size businesses with a blend of value and growth. In terms of the exposure breakdown by market sector, majority of exposure is to information technology or technology at 25%. Following that, the next big exposure is indeed to consumer discretionary here at close to 14% plus. Next, we have also some large exposure to industrials as well as healthcare. And we also do have some large exposure to financial sector. Overall, all in all, you're getting exposure to the entire stock market and entire market sectors. Some of the largest holdings for VTI include companies as Apple, Microsoft, Amazon, Nvidia, Google, Tesla, Berkshire Hathaway, Google Class C, Meta, Facebook, and ExxonMobil. Our next holding that gives us exposure to the US stocks is VEQT, Vanguard S&P 500 Index ETF. Here, we are more focused on the 500 largest companies in the US. This fund is offered through Vanguard Canada, VEQT, and is available in Canadian dollars. The last trading price for that, based on market price, was at $98.11. The MER, management expense ratio, for this fund is at 0.09%. Quite decent fee. Looking at the assets under management, you're looking at $7 billion plus, which is just incredible. And if you look at the 12 months yield in terms of dividend distribution yield for it is at 1.3%. Looking at the past return for VEQT, and if you look at it in particular for the 1 year return, this is at the end of March as well. The 1 year return based on market price was down by just about 1%. 3 years annual return is showing to be at 16.7%. 5 years annual return of close to 12%, and 10 years annual return of 15%. And the annual return since its inception is actually just shy of 16%, which is just incredible. The biggest exposure by market sector is to information technology at around 27%. Following that, we have healthcare, financials, and consumer discretionary. But you do also get other exposure at smaller proportion to other market sectors as listed here. And the biggest exposure by company is to Apple, then Microsoft, Amazon, Nvidia, Tesla, Berkshire Hathaway, Alphabet, different classes of the shares, as well as ExxonMobil and United Health Group. With VEQT, you do get your dividend distribution on a quarterly basis. The distribution yield at the end of February was at 1.5%. Our next holdings is one that gives us exposure to Canadian dividend paying companies. It's VDY, or Vanguard FTSE Canadian High Dividend Yield Index ETF. Currently, it's our largest holding in the portfolio that my wife and I have. VDY has an MER of 0.22%. It has a higher dividend distribution yield, given that it focuses on high dividend Canadian companies, with a 12-month yield of 4.52%. It has $2.1 billion in assets under management. With VDY, you are getting the option to track the performance of the FTSE Canada High Dividend Yield Index, which exposes us to high-quality Canadian dividend-paying stocks. Looking at the past return for VDY, at the end of March, the 1 year return was down by 8%. 3 year annual return, however, is up by 19%. 5 years annual return of 9.5%. 10 year annualized return of 8.5 to almost 8.6%, and annualized return of 9% plus since its inception. Quite decent return over the long period of time. Looking at the holdings here, you're getting exposure to VDY to 47 high quality Canadian dividend paying stocks. A majority of them are large cap businesses. Here, your exposure is mainly geared towards financials. More than half of your exposure is to financials. These include banks and insurance companies. Following that, we have exposure, close to a quarter of the exposure for this fund is to energy, followed by telecommunications, utilities, and consumer discretionary. You have slightly a slight exposure as well to basic materials, industrials, and real estate, but it's a lot less exposure in comparison to those other ones that we listed. In terms of the biggest holdings here, of that 47, you're looking at Royal Bank of Canada, Toronto Dominion Bank, Enbridge, Bank of Montreal, Canadian Natural Resources, Bank of Nova Scotia, Suncor Energy, Canadian Imperial Bank of Commerce, BCE, and TC Energy. Those are your top 10 holdings here. Next, we have another fund in our holdings that gives us exposure to Canadian market It's XIC or iShares Core S&P Toronto Stock Exchange Capped Composite Index ETF. The difference between XIC and VDY is that with VDY, you're getting mainly exposure to around that 50 or so companies, whereas here, you're getting pretty much exposure to the entire Canadian stock market. It's also low cost and designed to be a long-term holding for investors. Year to date, this fund is up by 7%. If you look at the past return of it at the end of March, the 1 year was down by 5%. However, 3 years annual return is at close to 18%. 5 years annual return is at 8.8%. 10 years annual return of 7.8%. And lastly, annualized return since its inception is at close to 7%. Decent return. On top of that, take into account that this fund does pay its dividend distributions on a quarterly basis. Currently, its distribution yield is at 3.17%. Looking at the management expense ratio for XIC, it is quite low at only 0.06%. Looking at the top holdings, though, we are looking at Royal Bank of Canada, Toronto Dominion Bank Enbridge, Canadian National Railway, Canadian Pacific Railway, Canadian Natural Resources, Bank of Montreal, Bank of Nova Scotia, Shopify, and Brookfield Corporation. These are the top 10 holdings for this fund. As for the exposure by market sectors, the biggest exposure is to financials. Following that, we have energy, industrials, materials, and information technology. You do also notice how the rest of the market sectors are showcased with lower exposures. Then we are moving on to our funds that gives us exposure to the international markets. And the first one here is Vanguard Total World Stock ETF, ticker symbol VT. This one is available in US dollars, this fund, and that's why we mainly maintain it in our RSP account to take advantage of the no withholding tax there. The expense ratio for VT is at 0.07%. This Vanguard fund is showing to be up by 8% year to date, 8% plus. Its performance at the end of March as well, if you look at it, the 1 year return was down by 7%. However, 3 year return annualized is at almost 16%. 5 year annualized return of close to 7%, and 10 year annualized return of 8%. If you look at the annualized return since inception, is close to 6.5%. Looking at the number of stocks here, you're looking at close to 9,500 stocks, mainly geared towards large cap businesses that are a blend of value and growth. This fund that gives you exposure to international markets does have some exposure to emerging markets in it. So about 10% of it is exposure to emerging market. The rest of it is pretty much to the international markets. Though keep in mind that it has some exposure, some actually massive exposure to North America, mainly US companies, around 62%, which is not surprising that top holdings include companies like Apple, Microsoft, Amazon, Alphabet, United Health, Johnson & Johnson, Alphabet Class C, Berkshire Hathaway, ExxonMobil, and JP Morgan. Pretty much the top 10 holdings, all of them are indeed US companies. Next, we have a fund that gives us exposure to international markets with ticker symbol XEF. This one, if you look at the specifics of it, it actually excludes the exposure to the US or North America. It's mainly geared towards international. Its biggest exposure is to Japan. Following that, we have exposure to UK, France, Switzerland, Germany, Australia, Netherlands, Sweden, Denmark, and Italy. So very much pure focus on the international, excluding the North America. EAFE stands for East and Far East Index ETF here. It's looking at the past performance at the end of March. The 1 year was up by 5.5%, 10-year annualized return of close to 11%, 5-year annualized return of 4% plus, and annualized return since inception is 7.8%. This fund does pay its dividend distributions, but it's paid on a semi-annual basis, and dividend distribution yield for it is at 2.10%. It is also considered to be low cost at only 0.22% management expense ratio. The top holdings here consist of some other holdings and ETFs, including IEFA, as well as some other businesses such as Nestle, Novo Nordisk Class B, LVMH, ASML Holdings, AstraZeneca, Roche Holdings, Shell, Novartis, and Total Energies. These are the top 10 holdings for this fund. Next, we have a fund that gives us exposure to emerging markets. It's available with ticker symbol XEC and offered through BlackRock's iShares Core MSCI Emerging Markets IMI Index ETF. Year to date, it's up by close to 4%. It gives us access to the long-term growth potential of emerging markets, and it's a good way for us to own over 1,500 stocks from emerging markets around the world. Looking at the past performance at the end of March, 1 year was down by 3%, 3-year annual return of 6.7%, 5 years down by about 0.5% annually, and return since inception annually is about 4.6%. Definitely, the returns is somewhat shaky, but you're getting exposure to the emerging markets, and it has its own ups and downs and some of its own unique risks as well. Good way for our stock market portfolio to be diversified through getting exposure to emerging markets. It has a fee of 0.27%. Looking at the top holdings here, you're looking at Taiwan Semiconductor Manufacturing, Tencent Holdings, Samsung Electronics, Alibaba, and Reliance, as well as the other companies that are listed here. Looking at the exposure by countries, geographical exposure, China accounts for about 29% of our exposure. Following that, we have Taiwan, India, South Korea, Brazil, Saudi Arabia, South Africa, Mexico, Thailand, and Indonesia. These are the top 10 geographical exposures. If you look at the rest, we get also exposure to Malaysia, UAE, and some other that accounts for that 6%. Exposure by sector consists of about 20% to financials, another 20% to information technology, and following that, we have exposure to consumer discretionary, materials, communication, and industrials, as well as the rest that are listed here for you. Moving on, our final pick is one that gives us exposure almost as an all-in-one ETF with an MER of 0.24%. and a 12 months yield of close to 2%. The unique thing about VEQT is that its dividend distributions are only paid once a year. They're typically paid in the months of January to you. As the name suggests, it gives you exposure to a number of underlying ETFs that all in all, they give you exposure to Canadian markets, US market, international market, and emerging markets easily, as in all in one basket ETFs. Looking at the past return at the end of March, the 1 year return was down by close to 1.7%. The 3-year annualized return was up by 15%. And annualized return since its inception is 9.3%. VEQT was not incepted that long ago, and that's why you don't see its annual return in the past 5 years or in the past 10 years. In fact, its inception date goes back to January 29th of 2019. Looking at the number of stocks underlying this fund, we are getting exposure to 13,600 plus funds. And zero bonds is 100% exposure to stocks. And mainly, they are large cap businesses, close to 80% of these funds. In terms of the breakdown by countries and geographies, about 42% of exposure is to US, around 30% is to Canada. The remaining, as you see, you get exposure to Japan, UK, China, France, Switzerland, Australia, Germany, Taiwan. And these countries that I listed account for almost 91% of the exposure. There are some other markets. In total, there are about 51 different markets here they give exposure to, but you're getting exposure a lot less to those ones. They're probably a fraction of a percentage points. In terms of the sector breakdown, your exposure is mainly to financials. Following that, we have exposure to technology, industrials, consumer discretionary, healthcare, and energy. You do get exposure to the rest of the market sectors, as pointed out based on the percentage point listed there. As I pointed out, the dividend distributions here is only paid once a year, and it's typically paid in the months of January of each year. Before I wrap up the video, I want to take a quick look at our portfolio that we have. Currently showing a total value of $453,000, up close to 3%. It is up in unrealized profit of close to $13,000. Looking at our holdings between my wife and I, we have these 9 funds that we went over, but our largest exposure is to VDY, currently accounting for 35% of our portfolio. We have a total of 3,668 shares, and it's up by 2.9%. Our second largest holding is VFV. It's up currently by 5.6%. We have about 27% of our exposure to this fund. Our third large holding is VEQT. which currently has a market value of $101,709, up about 1%. Our best performing fund here is VEQT, which is up by 5.6%. Following that, we have shares of XEF that are up by 4.5%. Worst performing funds are XUU and XEC, which are recently added to our portfolio. They're both down by 0.2%, just a fractional point, not even down that much. I also wanted to lastly show you quickly this dividend calendar that I've put together, showing you how the 9 different funds that we have in our portfolio pay us dividend throughout the year. The months of January and June are the months that we usually expect to receive the highest amount of dividends, because 7 out of those 9 funds pay us dividend during that month. Other than that, VDY is the only fund that pays us dividend on a monthly basis. That's why they're appearing on each and every single month there. Aside from January and June, the next other set of months that we expect to receive a high dividend are the months of March and September. In those months, we get dividends from 5 out of those 9 ETFs that we have in this portfolio. I would love to hear from you. Let me know, what are your biggest dividend paying funds in your portfolio? Do you have any of the similar ETFs in your portfolio? Leave me a comment down below and let me know. Well, thank you so much, everyone, for watching this video until the end. I hope you found it beneficial and you gained something of value from it. If you did, don't forget to smash that like button and subscribe to our channel. Here on Moementum Finance, we post every week videos about investing, including investing in stock market, through passive stocks, ETFs, dividend investing. We also talk about ways to reach financial freedom. Thank you, and I hope to see you all next time.